They say the road to hell is paved with good intentions. And what better example for this video than something called marking to market, a concept that accountants came up with thinking they were doing their best for the investment community, but actually, in a few cases, it's led to pandemonium and something of a disaster, particularly when we look at the subprime and credit crunch crises that blew up a few years ago. So what we're going to do in this video is to look at something that pervades an awful lot of the investing world now. It's called marking to market. Sounds a bit technical, but don't worry too much about it. This is not going to be a degree course, it's going to be a beginner's guide, and what we'll try and do is just explain what it is, what it's supposed to achieve, which sounds logical enough when you first hear it, and then look at some of the reasons it can make life pretty difficult for investors and what you can sort of do about that. Okay, so let's jump straight in, because it's one of those phrases that sounds a bit sort of jargon-filled. Marking to market. What is that? Well, basically, you have two choices. If you buy shares, you're presumably going to sell them in a few years' time and try and make a profit. In the meantime, well, what do you do as, say, a fund manager? All right, you could simply, probably what you and I would do, note what you paid for the shares, or wait until you sell them, compare the sales proceeds to what you paid, and say, right, that's my profit in a few years' time. Mark-to-market doesn't do that. What Mark-to-market says is, well, actually, what you need to be doing, Tim, is getting an up-to-date, accurate reflection of what the shares are worth as you go along. Okay? So Mark-to-market says you need to make sure you know what those shares are worth between now and the point where you sell them, and record any fluctuations as you go along. Even if you haven't sold the things, better to know up-to-date what they're worth in the meantime. So let's take an example. Imagine, a very simple example, I paid £1,000, and that's because I bought, let's say, 1,000 shares for £1 each. All right, so let's say right now, we could say I've got 1,000 shares at £1 each, so that's a cost of £1,000. Okay, and here's what happens next. I'm going to keep them for a few years. So after a year, right, the share price has dropped, as it might do, to 80 pence per share. So that means that my portfolio, if you like, is down to £800. I've still got the shares, I haven't sold them yet, but the share price has dipped by 20p, and so therefore is the value of my 1,000 shares. Okay, by the end of year 2, let's say share prices have dipped a little further by another 10p, so we're down to a £700 portfolio. All right, if I'm keeping a sort of ongoing score, let's say a year later, all right, share prices climb a little bit. All right, so having paid £1, they dip to 80p, then to 70p. Share price then climbs a little bit in the open market at the London Stock Exchange to 90p, taking my portfolio to £900. At the end of year 4, the share price climbs a little bit further still to £1.10p. Okay, so now I'm up to £1,100, and then I decide to dump the shares that I'm holding. Okay, so I sell the lot, let's say right at the end, for the market price of 120 pence per share. All right, so my shares are sold for £1,200. Right, so there's a very simple, short trail. I start off paying £1,000 for my shares. I eventually managed to sell them for £1,200. In the meantime, okay, the market price fluctuates. All right. Now, I said there are two ways you can deal with this cycle, if you like. One of them would be, as a private investor, you might just say, well, what I'm going to do is just record the shares at their original cost, £1,000, and when I sell them, okay, I'll simply record the difference between what I paid and what I'm getting as a profit, £200. Okay, but mark-to-market principles say you can't do that. Okay, what you need to be doing as you go along is recording the change in the value of the shares, even though you haven't sold them. Okay, step by step, year by year. So let's see what those two systems would do in terms of a profit and loss account. All right, so here's a profit and loss account. Now don't get frightened by the language here. This is just a back of an envelope calculation, okay? If you think about it, if I do what's called cost accounting, and don't get freaked out by the language, if I simply say, well, I bought them for 1,000, until I sell them, I don't care what they're worth, really. All I do is, well, I wouldn't worry about any profits or losses because I haven't sold them yet, all right? So under, if you like, the old system, pre-Marktomarket, you might have said, well, when I sell them, I'll book my profit of £200. Until then, I won't worry, all right? Because until you sell something, where's the gain or loss? But Marktomarket principles say, no, that's not right. That's not right, Tim. What you need to do is get data that tells you what your shares are worth at the end of each period and book the resulting profit or loss as you go along. Okay, so before we ask whether that's a good idea, okay, how does that change the picture? Well, let's do a Marktomarket profit and loss account. Okay, that's the M to M P&L. All right, some of you can probably see what's coming. What's that going to look like? Well, here, what I've got to do is say, well, actually, I haven't sold the shares at the end of year one, but they've dipped in value. I paid £1 each. Okay, they've dipped to 80p. That takes the value of the whole portfolio down to £800. So I need to book a loss of £200. All right, a book loss of £200, hence the language. Okay, then what I need to do a year later is say, oh dear, well, I haven't sold, I'm not selling them yet, but when I go to the London Stock Exchange and look up the price, I can see the price has dipped. So what I need to do is, well, I booked a £200 loss last year to take account of that difference. Now they've dropped a bit further, so I don't need to book the whole loss again, but I need to book another £100 loss there, okay? Or a £300 loss in total were I to sell the shares right now, which I'm not going to do. Then in year three, oh look, the price has gone up a bit. Oh, that's good. So that's good news. So I can put a book gain into my profit and loss account for year three. Probably see where this is going now by comparing where I was to where I am. I can put a £200 gain into year three. I can do the same in year four because they rise again from 900 to 1,100. So I can book a £200 gain in year four. All right, and then when I finally come to sell them, I just compare what they're at in my books in year four with what I sell them for in year five, if you like. So there's a £100 gain at the end. All right, and just to check that you end up in the same position one way or another. So by saying, well, I'll just record the original cost at the start and worry about what I get at the end and then compare the two. £200 profit in the first example. If you add all of this up, doing the Marktomarket version, 200 down, 100 down, 300 down, 200 back up, 200 back up, so that's 300 down, 400 up, and another 100. So that's 500 of gains, 300 losses, so that's a £200 profit overall, or which is the same result, not surprisingly, as you get to it the first way. Has to be, because at the end of the day, okay, if you buy something for 1,000 and sell it for 1,200, somewhere in there, there's a gain of £200. Right, now you might be thinking, what was all that about? Okay, well, here's the answer. This system of marking to market, I know I use a very simple example, 1,000 shares for argument's sake. This system is the one that's often used in financial markets in practice. All right, because people say, well, this is more realistic. This is what you need to do. You need to have up-to-date information about where your portfolio is. So fund managers mark to market. Okay, fund managers, when they buy shares on a daily basis, or perhaps even more frequently, they will look up closing prices at the London Stock Exchange and adjust the value of the portfolio up or down and book the resulting gain or loss, okay, as a profit or loss. So they'll be keeping a running score of the value of the assets they own and booking the appropriate profits and losses as they go along. Okay. Derivatives brokers also use mark-to-market principles. In fact, some would say that's almost where they came from in the derivatives world. Now, I do some videos on derivatives, so I won't labour the point here, but if you get into derivatives, you buy derivatives, you're expected to put down a deposit, and that deposit can be varied on a daily basis by your broker. They can make margin calls. What they're doing is tracking the market price of the asset you bet on and deciding there and then, on a daily basis, or whether they need you to put a bit more kind of safety deposit down at the broker's account. Okay, so it's used in the derivatives market as a way of protecting the broker from a potential default on your side, based on the fact that derivatives get you a lot of bang for your buck. And if you have no idea what I've just said, do have a look at my What Are Derivatives videos for a bit more of a guide as to what's going on there. Okay, and the third place they're used, these mark-to-market principles, is companies reporting their results. Banks in particular make heavy use of mark-to-market accounting. So that means that every period they report, okay, they're looking to get their assets stated at market values, their liabilities stated at market values, and book any resulting gain or loss as a profit or loss. Right? You might think, well, that sounds great, because that means that all of these people are providing the most up-to-date, representative data on the assets that they own and control as they can. Surely that's the right way to go. All right? Surely that for investors is the best way to go. Not necessarily. Okay? So, first of all, what can I say in favour of mark-to-market? Okay? Because there are a lot of things to say against it coming up in just a moment. So what can I say in favour? Well, one of the biggest arguments for doing it is that one I just made, that it presents realistic, up-to-date data on exactly the assets owned at the end of each accounting period or end of each period and the resulting gains or losses. Okay, it's a running track record, and it means, say its fans, that it's difficult to manipulate accounts by timing sales. What I mean by that is, if you don't have to do mark-to-market, you just sort of record an asset at cost and book a gain when you sell it, clearly it's tempting to wait till you think the asset is going to be sold for the maximum price and then book the gain, if you see what I mean. So sort of companies and so on and fund managers are accused of trying to time asset sales. Mark-to-market doesn't allow you to do that because it's taking a gain or loss as you go along based on the changing value of the asset. All right? But, boy, are there some problems with what might seem like a good idea. The road to hell is paved with good intentions. Well, get ready to jump on that handcart to hell, okay? Because there are quite a few things wrong with mark-to-market accounting. So much so that the Americans thought of banning it straight after the financial crisis a few years ago. Wow, okay? So what's wrong with it? Number one, no prizes for guessing which is the more complicated way to do things, okay? Is it number one, book the £1,000 cost, take the profit when you sell it, anyone can do the maths, sell for 1,200, buy for £1,200 gain, job done, okay? Mark-to-market is fiddlier. It involves working out the value of your assets at the end of each period and taking the resultant gain or loss. Now you might say, oh, how difficult is that, Tim? Frankly, if these are 1,000 shares listed on the London Stock Exchange, how hard is it to just look up the price and record the rolling difference? The answer is, it isn't very difficult, but that's because there's a readily available price, right? And what do you do when what you're trying to do is to mark-to-market assets which are very, very difficult to price? Okay, I mean, where's this £800 coming from? Where's this £900 coming from? What if these are unlisted, illiquid securities? What are you going to do then? You can't just look up at a price at the London Stock Exchange. There won't be one. Okay, at that point, where assets are difficult to value, you get into something called marking to model, or marking to madness, as I would call it. In short, you have to estimate what you think the asset might be worth in the open market, even though you're not selling it, and book the corresponding profit or loss. Okay, and if that sounds a bit dodgy, it is. Okay, so flaw number one, it's more fiddly. Well, that's not a reason not to do it, but it is more fiddly. Flaw number two is, what do you use as the asset value when it's not obvious? Okay, and that is a problem. Flaw number three, it creates volatility. I mean, look what's happening to this profit and loss account. Down a bit, up a bit, up a bit, up a bit, whereas this one's flat. And some would say, well, this one's more realistic. All depends, okay? Around the time of the credit crunch, for example, what was happening was assets were plunging in price. Everyone panicked. People were saying, God, suddenly all these assets are plunging in value. I've got to mark my whole portfolio to the value of that one asset that's plunging through the floor. So banks were suddenly writing down assets, across the board on the strength of a low level of transactions for quite dodgy assets, all right? So it can create kind of pandemonium short term. In other words, something that was designed for the derivatives market where short term matters shouldn't necessarily be lumped onto assets which you have no intention of liquidating today or selling. because it can create panic where there shouldn't be any. Okay, let me give you another example of that. Okay, pension deficits and investments in companies. All right, the sort of idiocy that mark-to-market can create is this kind of thing. You know, a pension fund deficit arises when a company looks at the value of the asset set aside to fund pensions for its employees, compares that to the cost of meeting future liabilities to all the employees who are going to retire in the future. So it's got a lump of assets, stocks and shares, for example. It's got liabilities, being the amount it's going to have to pay out to future retirees, and the difference can easily be a deficit, quite a big one. All right, now, if short term, because bear in mind, people don't all retire in one lump. You're talking years and years and years and years of future retirees potentially. All right, now this isn't a pensions video, but if asset values plunge because the stock market suddenly falls through the floor, mark-to-market says, yeah, and what you've got to do is recognise in your accounts the true horrendous scale of the resulting deficit. Because if that plummets, that's going to rocket, even if nothing happens to that, if you see what I mean. Okay, so stock market crash, deficit rockets, and suddenly you end up with this bizarre situation. Someone once described a few years ago, maybe not so much now, Rolls-Royce as a pension deficit with an engineering company bolted on the side of it. All right, because you can end up under mark-to-market principles with an enormous pension deficit. It doesn't mean anything, because it's not like it's got to be paid tomorrow, okay? Dwarfing everything else that a company is doing. And that's because of mark-to-market principles. Whereas a more sensible approach might be to say, well, hang on a minute, these checks are not going to be written for like 20 years. What we're doing, dumping such a huge deficit in the accounts now, probably to just reverse it all when the stock market recovers later. All right, that goes back to my point about volatility. Okay, and my final point is this: mark-to-market can result in some truly weird outcomes. Okay, take banks, for example. Here's a marvelous one. Okay, now if you follow this one, it's not too technical, but here's the madness of mark-to-market and something to watch out for. Okay, people do scratch their heads over this one, quite rightly. Okay, imagine you're a bank and you've issued debt, IOUs. All right, so that's how you're funded. You actually issued IOUs, and what happens is one of the ratings agencies comes along and says, you, that's the bank, okay, you're not as creditworthy as you used to be, so we're going to mark you down. What happens to the value of the debt you've actually issued? And the answer is the price will drop. Okay, the credit rating agency said you're not as creditworthy as you were, investors get frightened, and the value of your debt as a bank will actually drop. People won't be prepared to pay as much for it as they were before because they're worried. Okay, now here's the irony. That debt is recorded as a liability. You're a bank, it's an IOU. If it drops in value, that's great, because it means if you wrote a check tomorrow to clear it, which you're never going to do commercially, but if you wrote a check tomorrow to clear it, okay, you'd be paying less than you'd have to do yesterday. Mark-to-market fanatics say, and therefore what you need to do is record a gain now, okay, for the fact that were you to write a check to clear your own debts today, which you're not allowed to do, okay, or you're not going to do, you'll be paying less than you would have done yesterday because that debt has just been downgraded and fallen in price. All right, so you book a gain for the fact someone thinks you're crappier than you were 24 hours earlier. All right, and that's the kind of weird nonsense that can result from this obsession with marking everything to market. Okay, so to sum up, mark-to-market, I'm afraid, love it or loathe it, and you can probably tell what my view is, pervades everything in financial markets. Fund managers use it. Okay, I get that. Okay, although it does encourage short-termism where possibly it shouldn't. Okay, derivatives brokers use it. Sensibly enough, derivatives are short-term instruments. You need to. Okay, you can't let someone run a hugely geared derivatives position and not ask them for more money when it starts to go out of control. I get that. When it comes to looking at company results, okay, mark-to-market accounting is complex, it's fiddly, it's not understood by everyone, it results in anomalies, it can result in, frankly, very, very weird treatment of certain transactions. So you end up having to ask the question, is it actually really worthwhile? All right, or is it an example of the kind of academic end of accounting running out of control and making life rather messy for those of us that have to make practical day-to-day investing decisions.